Hi, Boaz, thank you very much for your introduction, and I want to welcome everyone to today's edition of our Financial Immunity Community. Our goal for this session is to learn about mutual funds, one of the investment products that we believe, if many people understand and appreciate, would be able to commence their journey towards achieving financial independence. At our last webinar, we discussed stock trading, how you could understand the stock markets, and we did a practical session so that everyone could appreciate what it takes to make money from the stock exchange. Today, we are going to be doing mutual funds, and in the coming months, we are going to be treating other topics under insurance and a number of products. Now, this is a very important topic I need everyone to pay some little attention to, both on Facebook, on YouTube, and those of us in the studio on Zoom. Now, remember that in all our sessions, we've been talking about understanding the financial markets. And when we talk about financial market, it's simply the universe of finance and financial services. And the last time we said that there are two categories of markets under the financial markets. The first is the capital markets, and the second is the money markets. And we said that the money market simply looks at financial instruments in the short term. And when we say short term in finance, we just simply referring to a year or less. So any investment that matures in a year or less is sitting in the money markets. And then capital markets go beyond that. So usually capital markets are long-term markets and money markets are short-term markets. So under the financial services market, you have the capital markets and the money market. And we said that in the money market, you have instruments like the treasury bill, fixed deposit, etc. And then in the capital market, you have instruments like stocks, you have long-dated bonds and other things. And we mentioned from the last time we did our last session on stock trading, we said that stocks or shares or equities sit under the capital markets. Today, we are treating a very important product called mutual funds. And mutual funds can either sit under any of these markets, depending on what goes into the fund itself. So it's important to appreciate what it is so that you would know what to do in terms of what to buy if you have some money to invest. Now, when we say a mutual fund, it's simply a fund that is a company on its own and has a number of people who are paying money into a fund, and they appoint somebody they call the fund manager. So the fund manager, who is a professional, who is an expert, decides based on the mutual funds particular objective to buy particular securities, and then the returns that are accrued out of that securities the fund manager buys are now shared among all the people who contributed into the fund, so that the investor gets something back in return. So simply, a mutual fund is a fund that collects contributions from a number of investors. And these investors who put this money in leave the responsibility of managing that fund to the fund manager, who is a professional. And this professional, based on the mutual funds objective, among other things, puts the money into particular securities or investment instruments. And as the instruments return or make some good gains, it is shared amongst the people who put their money together into the pool that we call mutual funds. And so basically, that is what a mutual fund is. Now, a mutual fund is into what we call a flow path. And this flow path is what is on the screen. Just take a look for it for a minute. Now, if you look at this path carefully, you will see that the investor has money. He puts the money together with other people who are contributing some other funds, and then they take it to a fund house. In other words, maybe a fund, an asset management company. And then the asset management company has somebody they call the fund manager. And this fund manager's responsibility is to use his professional abilities and the objectives of the fund to now put all the funds that were paid by investors into one pool, into specific selected securities. And then those securities are meant to work. So when they work, they generate some returns. And because the funds were funds that were pulled together from several investors, it is shared amongst them based on the number of shares they all have. So a mutual fund goes through this flow path. And this is what it does. So investors put their money together, comes to the fund manager puts into securities, financial instruments, get returns ultimately, and then passes it back to the investor. And this is the path that goes on for every mutual fund. Now, there are types of mutual funds, but I want you to understand the types based on 4 critical things. There are types based on the asset class. When we say asset class, it's just simply the type of securities that the mutual fund will invest in. And then there are types based on the structure. Structure simply meaning how the mutual fund is arranged in terms of the type of fund it may be. And then the types based on what we call investment goals. And then the type based on risk. Again, take your time and look at this. So if you look at the type based on asset classes, you will see equity funds, you will see debt funds, you will see money market funds, and you see hybrid funds. So when we talk about mutual funds based on asset classes, it means we are talking about mutual funds that invest in equities. And remember, we did equities last month, simply shares. So it invests in shares. Debt funds are maybe like treasury bills, for example, because treasury bill is a debt instrument. You give your money to government and the government pays you some return, or even fixed income instruments. And so those become debt funds. Money market funds, remember in the capital markets universe, we said instruments that mature in a year or less. So any of these things that is combined, more than one, becomes a hybrid. So when a mutual fund invests in any of these, it takes on the nature of the security it's investing in. And so it becomes the type of mutual fund. That means there are money market mutual funds, and there are equity mutual funds, and there are hybrid funds, among others. The next one is based on structure. So that means there are mutual funds that are open-ended. We call them open-ended. Open-ended simply means that it never closes on anybody who wants to contribute. So you put money in today, tomorrow somebody can put money in. When we were doing the stock trading, remember we talked about IPOs, and we said that IPOs are initial public offers where companies that want to raise capital go to the stock exchange, and because they are coming onto the market for the first time to get people to buy into their stocks or shares, the first offer they gave to the public is the initial public offer. Now, after an initial public offer, you can't buy at the initial public offer again. So usually it is close-ended, just to explain what an open-ended means. So the open-ended means there is no deadline as to when you can buy. You can buy at any time. The close-ended is there is a time period where after purchase, you can't come in and buy again. And the interval funds are the hybrid of both. So there are mutual funds that are open-ended funds, and there are mutual funds that are close-ended funds. Now, that should tell you that there can be, say, a mutual fund that is equity in nature and is open-ended. So I'm just explaining that These things give you the type that the mutual fund can fall under. So the asset gives it a nature, and then the structure also gives it a nature. The last two things that can also give you an understanding to what kind of mutual fund you are buying is the investment goal and then the risk that is associated with that mutual fund. Now, here, there are some mutual funds whose job are to just grow the funds that are being pooled by different investors. And there are mutual funds that are meant to just give you regular income. So they are income funds. And there are mutual funds that are just meant to give you access to the funds at any time. So liquidity. And there are mutual funds that are supposed to give you some savings on tax. When you buy them, you get exemptions. So again, you can have an equity mutual fund that is maybe open-ended, and that is a growth fund. So that gives you a type, if you understand it from these three categories, that a mutual fund must have an asset class, a mutual fund must have a certain structure, and a mutual fund must have an investment goal. And then the last part is the risk type that gives you an idea as to what mutual fund it is. So some are very low risk, some are high, and some are medium. Now, this is very easy to tell if you are looking at the asset classes of the mutual fund. So if I bought an equity mutual fund, remember, equities are in the capital market. They are long-term. So if a mutual fund buys, or the securities a mutual fund is investing in is equity, it's simply shares. And remember, shares have high risk. So then immediately you will notice that this is an equity mutual fund that may be open-ended, and that may be a growth fund because it's meant to grow your account, and high risk. So you have to understand all these anytime you want to buy a mutual fund. So you'd appreciate what kind of security the mutual fund is investing in. What is the structure like? Is it open-ended? Is it closed? Can I buy anytime, or it is over a period? What actually is the goal of this fund? Is it to grow? Is it to give regular income? And then what is the risk associated with this fund? The understanding of these four pillars helps you to know the type of mutual fund you will be buying. Now, having learned that, you can see from this table that by structure, a mutual fund will either be open-ended or closed-ended. It is here, if you look at the based on structure. And then by objective, again, look at objective. Here, it's the same as investment goal. So the investment goal will tell, if it's growth fund, it will tell what kind of assets it will buy, and it will tell what kind of risk is associated with the fund. And so it's very important always to know the structure and to know the objective of that fund. So in simple terms, what are the benefits of mutual funds? Because now we are saying that mutual fund is one of the investment products you can buy if you are looking for an investment to buy. And we've talked about what it is in terms of investors putting money together, putting it into a fund that is a registered fund, like a company on its own, has a fund manager. The fund manager, professionally licensed manager, puts the money into some securities, generates some returns, shares it across the people who bought it. And it goes through that cycle over and over and over and over again. And the types based on asset class, structure, investment goals, or risk will put you into knowing that the structure of your mutual fund and the investment objective of mutual fund is important to know, because it will determine the risk. It will give you an idea of the risk, and it will also give you an idea as to the kind of objective the mutual fund is about. So on advantages, mutual funds are very simple to buy. If you want to buy a mutual fund, unlike maybe a stock where you have to find a licensed broker, and then the broker will have to make a purchase request on your behalf, make a bid, and then when it's available, we'll now buy. A mutual fund is not like that. A mutual fund, you just walk into any licensed asset manager who has a mutual fund that has been licensed by the Securities and Exchange Commission, and then you make a purchase, particularly if it's an open-ended mutual fund. Number two is professionally managed, so you don't just guess. The professional manager that has the license decides on your behalf what must be done the moment you buy the fund, because the fund has guided particulars in a scheme that becomes the guiding path for where funds are put. He uses his professional expertise to manage the funds for all the contributors who are contributing into the pool. Then mutual funds offer diversification. Remember that the asset classes can be a number. So if a mutual fund is investing in equities or shares, it simply means that that pool that you are contributing into can be buying so many shares. Unlike if you wanted to buy maybe some stock on the Ghana Stock Exchange, you may be limited with, say, maybe 1,000 cedis to buy a certain number. But because mutual fund is a pool and so many people are contributing into it, there is enough resource from so many people to buy so many asset classes in terms of the security they are providing. So that is where the diversification, which is point 3 advantage, comes in. It's conveniently administered. It gives higher returns, and this is comparative, depending on which one you bought, comparatively. If you follow your investment goal and if you follow your risk return guideline, comparatively, it pays higher than a regular fixed income instrument. And then the cost of managing it is comparatively low. It offers liquidity to say you can withdraw. You can withdraw. Again, here, if a money market mutual fund, money market meaning anything that matures in less than a year, and an equity mutual fund, anything that is into shares. Remember, shares are in the capital markets. So if a money market, a mutual fund invests in money market, it should tell you that it will take on the character of money market instrument. If it's investing in equity, again, it tells you that it is taking on the character of equities. So a mutual fund that invests in equities, we call it an equity mutual fund. That means that equity mutual fund will be buying shares. Here, I'm talking about liquidity. If you went to buy shares directly, you don't tell when you can even withdraw or sell, because selling is dependent on when there's an available offer to buy. So there is no timeline as to when it will be bought. But if you bought an equity mutual fund, as at now, maximum 5 working days, even if it's in an equity mutual fund, which is buying majority shares, you still have access to your money in real time. And so that gives you liquidity that maybe a direct stock might not have given you. Then it provides transparency. If you are buying a mutual fund, there is something we call a scheme particular. The scheme particular is like if you were buying a stock, something called prospectus. It outlines everything about the mutual fund and gives you also a peek into what exactly they are doing. And then it allows you to switch. Anytime you've bought mutual fund A, you have mutual fund B, you want to switch. If it's the same manager that is handling it, it's easy to switch, and that makes it easier. So with very little amount, you are able to leverage on these advantages of buying mutual funds. Having said that, there are disadvantages. The number one disadvantage is that because it's a pool and it goes into a market, again, look at it carefully. I said based on asset classes. So equity funds, debt funds, money market funds, or hybrid funds. That means if it buys, say, maybe shares, and it's an equity fund, the risk of the market of equities affects same, because I said it takes on the character of the securities the fund is investing in. So the market, if the market is tumbling and it's investing in equities, then your mutual fund is also going to tumble, it's going to fall. If it is rising, the stock market invested in shares, and the shares market is rising, we learned that when the share market is rising, it is called bullish. And so if it's invested in a market that for some time has become so bullish, meaning they are recording good returns consistently, then the mutual fund will take on that character. So based on the asset class, the market in which the mutual fund has invested in, the risk of that market reflects on the mutual fund. Again, number two disadvantage is that there are no guaranteed returns. So maybe you bought a mutual fund that is investing in maybe a fixed income instrument. Ordinarily, if you bought a fixed income instrument as a single person without putting it in a fixed income mutual fund, it will promise you a particular return over a particular period. But because a mutual fund is buying a number and it is being managed together in a pool, it cannot promise you any return. It doesn't matter the asset class. It can give you an idea about past returns, but it cannot guarantee you a return. A treasury bill, for example, can guarantee you a return over a period. A fixed income instrument or a fixed deposit account with a bank can, but a mutual fund, it doesn't matter the asset class, may not be able to give you any guaranteed returns. Then the third thing is diversification of portfolio does not necessarily maximize returns. Well, diversification of your portfolio is great. It helps you as an investor to reduce your risk, but it also doesn't guarantee that you maximize your returns, because remember, market risk means there are times when the market in which the investments were done will probably all not be doing well. And so even if you have diversified and almost all the markets are not doing well, it reflects on the mutual fund. So that is another limitation. The next one is selecting the right financial securities not being easy, and then cost management not proportional to performance. That is to say that mutual funds have cost implications. There are charges on them, which I'll explain later. Then unethical practices may creep in if it is not checked by the regulatory body. And then sometimes there are hidden fees, and I'll talk about all of them. But if you look at this dashboard carefully, you can tell that for anybody who is a beginner in terms of investment, it's always safe, it's always accommodating to begin with mutual funds if you want to earn more than maybe the regular money market or fixed income instruments. So what are the fees that you have to look out for anytime you are buying a mutual fund? Basic fees you should look out for. Remember, we talked about classes, and we said, let me go back to that. We said based on structure, a mutual fund can be open-ended or closed-ended. Now here, I'm just talking about when we say load is a fee. So there are mutual funds that have no loads, and there are mutual funds that have loads. So simply, there are mutual funds that have charges, and there are some that do not have. Having said that, the ones that have loads, so as you are buying a mutual fund, you should ask, is it a load fund or is it a no load fund? If it's a low fund, it means there are some costs in terms of fees. If there is no low fund, it means probably there is another way of making, paying for the fees and the bills for that fund. So almost all the time you'll find a load fund, and the load should be a management fee for the fund manager who is using his professional expertise to manage, a front end load, which is like the moment you buy that mutual fund, there is a fee they take. So when you are leaving, they don't take any money again when you are withdrawing. And there are others that have exit load. So when you hear exit load, it means when you are withdrawing, they will take some fee. So the next time you are buying a mutual fund and you ask about whether it's a load or no load fund in terms of the fees, you should ask whether it's a front load or an exit load. So the front load means the day you put your money into the account, they take something out as a fee. The exit load means they take it when you are withdrawing. Some actually have both front end load and exit load. So this is also a guide. It helps you to know what mutual fund to buy and the one not to buy in terms of fees. Then these are must knows before you buy a mutual fund. Important to know, important to understand before you buy a mutual fund. Anytime you are buying a mutual fund, know that the moment you put your money into the mutual fund, you will be allocated a number of shares. So it's always important to check what the price per share for that fund is. It gives you an idea as to the number of shares you are going to make when you buy a certain amount. So for example, if I'm putting 100 cedis into the fund, and they tell me that the price per share for this fund is maybe 1 cedi or $1, immediately it should tell you that you're going to have 100 shares, because you will divide the price per share by the amount you are putting there. Or you divide the amount by the price per share, the other way around. So say $100 you are putting in, 100 cedi you are putting in, 100 rand you are putting in, but the price per share is $1, 1 rand, 1 cedi. So it's 100 so and so over the price, and it gives you the number of shares you are going to make. Remember that then the more shares you have, the more you make on your return if the fund is returning very good returns. So always take note of the units that you make or the shares that you make after buying any mutual fund. Usually, after you've bought any mutual fund, they will send you a purchase confirmation note. And in that purchase confirmation note, usually within 24 hours, they would be telling you how many units, fund units or shares your money was able to afford you. And then you can always multiply the current price by that number of shares, and you yourself can calculate how much you are making. The next thing is a net asset value. They call NAV all the time. It's simply the value of the fund. Usually, NAVs are calculated at the end of every day because mutual funds trade daily. It works daily. It works for you daily. So at the end of every day, there's a value per every share you bought or per every share you sold. And that is what goes into the price per fund unit, so that you're able to tell every day whether your fund is making a gain or loss. So you must also be asking, what is the NAV for today? And you should be asking, what is the price per share for today? So you know the units you have. The lock-in period is simply, in other words, the minimum or the recommended minimum holding period. So when I put money into this mutual fund, what is the minimum duration I can put the money in without touching? When can I come back for it without any charges? That is a lock-in period, or the recommended holding period, or the withholding period. So you should ask, if you put your money into a mutual fund that says minimum lock-in period maybe is 91 days, and you go for it in 21 days, they will charge you, particularly if probably it has a front end load, because the moment you put the money in, they've taken their charge. And so usually the lock-in periods are supposed to protect you from losing anything on the account. And then the load charges, which I've explained, you must always ask, what are the charges on this account? Is it an entry load or an exit load? What is the entry load fee? What is the exit load fee? So that you always have an idea and you are not surprised on the day you are making a withdrawal or otherwise. Then you'll be given an offer document that spells out the investment objective, the asset classes, and almost everything on that fund, so that it guides you. Remember, it guides you. Usually it is also called a scheme particular. Then you must ask the assets under management. The assets under management is simply what is the total contribution and its return, all in value as at the time you are buying. It tells you the size of the fund. And usually the greater the size of the fund, the better it is. The expense ratio is simply about the percentage of expenses incurred by the fund compared to the total contributions in terms of assets. So the expense ratio can also give you an idea as to how bad it will get if they have to charge you. And then new fund offer is simply just like an IPO. An IPO, if you are buying shares, is like an initial offer. A new fund offer is like an IPO for mutual funds in simple terms. And then redemption, you should always know. You should always know when you want to withdraw, what is the process of withdrawing and getting out of the fund you invested in. 5 mistakes you should avoid anytime you are investing in mutual funds. 5 mistakes you should avoid. I want you to take your time and look at it before I explain. So take your time, look at it carefully. 5 mistakes you should avoid before you buy a mutual fund. 5 mistakes you should avoid before you buy a mutual fund. It's important to understand that before you buy a mutual fund, there are some things you should not do. Now, number 1 is that you never have to buy an investment, actually any investment, but in this instance, you don't have to buy any mutual fund without a plan. The plan is, in other words, the investment objective. Remember, we've done this in a number of sessions. Your investment objective is always important. So your plan is your investment objective. Go back and look at what we said about the types look at the right side, we said based on investment goal. So every mutual fund has an investment goal. So when I say never invest in a mutual fund without a plan, your plan would either be to grow your funds, to get regular income, to have access to your money when you need it, or to dodge some taxes and make some savings. It is that plan that should guide you as to what mutual fund to buy. And so never just go out and say, I want to buy a mutual fund without clarity on what exactly it is guiding you, so that your plan coincides with the investment objective. Example, I have some money, I need it in 3 months' time because I'll use to pay maybe my rent and I don't want to spend it or put it in my bank account. This plan of needing the money in 91 days or in 3 months should guide you to what mutual fund you buy. So as you go about asking for which mutual fund to buy, one of the things you ask is that which mutual fund can I make something decent on and still have access to it in 3 months? That is your plan. It must coincide with the investment objective. Then the timing of the market. When you are buying mutual funds, you don't wait like you are buying stocks. No, in stocks, we said you buy when the market is bearish and you sell when the market is bullish. So you time the market and look for when the market is down. In mutual funds, particularly for open-ended mutual funds, you can buy at any time. So you don't waste your time on when to buy. The best time to buy is now. And then you don't have to be frequently reshuffling your funds. You buy here tomorrow, you move from this, you put it into that. Every one of those will cost you. So you don't do reshuffling and you don't do panic exiting. You put your money into the mutual fund today, tomorrow you went to check it has fallen a bit. Don't panic and exit, because when you do, you'll be losing out. And you don't buy unnecessarily too many funds. These 5 mistakes you don't make. And if you don't make them, you are safe. It helps you to become successful anytime you want to buy a mutual fund. I would be talking about the top 6 tips to pick in terms of the kind of mutual fund to buy. I'll be talking about that. But as I get ready to talk about that, I'll pick some questions and then I will end my very final answer with the 6 tips that you need. Now, I'll be talking also about this app called Penny App before we leave. So at this stage, there are so many people also in the waiting room. Admin, you can admit them, whilst you can bring your questions into the chat box and we can answer them for now. So let's hear you put your question in there and let's answer you before we do the very last portions, and then we'll end for today. Thank you.
Okay, thank you very much, Richmond. So we'll move on to the questions. I think currently we have no questions for the mutual funds. Currently, we have no questions for the mutual funds.
I have a question.
Okay, there's a hand. Jacob Anna Kwampong has a question.
Yes, Anna
Kwampong, go ahead.
Good evening. Good evening. May I know why when you invest in your fund, although the investment has not immediately you do your, let me put it, your profit is added to your capital, although the investment has not been done. Why?
Ask your question again, please.
Okay, I want to know why is it that when you start with a mutual fund, the very moment you start, your profit is added to your seed money, although the investment has not been done.
Okay, so let me break it down. You buy a mutual fund 50 cedis today. Tomorrow you went to check and it is maybe 52 cedis, right? Jacob,
Yes.
Is that right?
Yes, please.
Okay, so this is what happens. Remember, we said that mutual funds, particularly the ones that are not closed-ended, they trade daily. And so the moment you put your money into the account, you are offered a number of shares. And remember, I spoke about the NAV. The NAV is calculated daily. So you can put your money into a mutual fund today. And if you bought one share, maybe fund unit at maybe 1 cedi, if at the end of the day, every share has moved up, the return you are entitled to same, and you'll be giving some. So the next moment you notice that it is up. That is how mutual funds work. They work daily. They work daily. So that is how it works. Thank you. I see another hand from Richmond. Richmond, your question, please.
Hello, please. If mutual fund yield is quoted like YTD 2 + 227, what does it mean?
Right. That's a good question. YTD is simply year to date. So year to date is saying the mutual fund works daily. And so using this example, YTD will mean from January 1 to today. This is how far the market has returned. Then there are some that are called annualized. So the annualized ones, they are looking at 12 months in session. So for a year. So if an annualized rate is giving you 10%, it's over 12 practically. But a YTD is almost a full rate from January to the date in question. That is year to date. Thank you. Winnie Francis, I see Winnie Francis. Please go ahead with your question. Winnie Francis, kindly unmute and go ahead with your question.
Hello.
Hi, Winnie, we can hear you.
Yes, I am saying that assuming I invest in a mutual fund, then you buy shares. I mean, I want to find out, is there a platform that I can also be able to see whether the price of shares are going up or down?
Sorry, we lost you. Can you repeat your question?
I am saying that, can you hear me?
Yes, sir.
Can you hear now? Yes, I am asking whether if I invest in your mutual funds, then you buy shares. And then is there a platform where I can also sit in my local room and be monitoring the price of shares on daily basis?
Right. That's another intelligent question. So if you bought a mutual fund and the mutual fund will say an equity mutual fund, ideally, your fund manager should be able to give you an idea as to what stocks or shares that particular mutual fund is investing in. And if the stocks they are talking about are even on the markets, like maybe in Ghana, maybe in the stock exchange, you can check every day yourself. If you don't get that, they always update you with annual reports. And even sometimes they give you portals on their website that gives you an indication of how those stocks they have invested in are doing. So yes, particularly if it is an equity mutual fund, you can check. But even if you cannot check, they always give you annualized updates that gives you an idea as to how well the stocks they have purchased are doing. Yes, thank you. Paul, do you have a question? We can see you have unmuted yourself.
Okay, Richmond, please, there are questions in the chat. Should I pick them?
Go ahead, please.
Okay, so Godwin is asking, what's the least money to invest in a mutual fund?
Well, it depends. It depends on the mutual fund type. But as at now, even 50 cedis can buy a mutual fund in Ghana.
Okay.
And you can top up for some, you can top up with as low as 10 cedis.
Delims D is asking, can you list some few credible investment houses that engage in mutual fund services?
I'll answer that with the 6 tips you need to pick before you buy a mutual fund.
Okay. So Samuel is asking, please, can you clarify the number of funds a person can have? Currently, I have 4 with its purpose or investment goal.
Well, ideally, 4 is not too much, but 4 means usually you have a short-term and emergency mutual fund. You have a long-term one, that makes it 2. And you have a medium-term one, that makes it 3. Unless you want to add maybe something for retirement, then it becomes 4. So at least maximum these 4 things can be achieved. Occasionally, maybe you want to buy a mutual fund for other purposes. Maybe you want to buy it for a project, you want to buy it for a business, you want to buy it in the name of another person. All those things can also become a reason why maybe you have multiple accounts. But as much as you can, it's important not to split out so much beyond 4. So 4, we can work with 4 if it serves all the 4 objectives you have outlined.
Okay, Fidelis is asking, must the fund manager be a human being? Or there are situations where it could be a machine programmed to do that? I'm asking this because machines usually charge lesser rates compared to human beings.
Well, I'm sure there will be a time we can do that, but this is purely stock selection analysis. This is P ratio integrations and things like that. So for now, you need a human being, a team that has practical hands-on expertise, and sometimes even with supervision from a chief investment advisor or investment officer and an investment committee that sits together with this fund manager to navigate the objective of the fund and to pick the best security. So this is complex. It's not like a straightforward thing that you do, and it is fluid. It is daily. So I'm yet to see any mutual fund manager that is a machine.
Okay, someone is saying he read a book authored by Donald Trump and Robert Kiyosaki. From their book, they advise that a person should not invest in mutual fund with a long-term investment objective. Do you agree or otherwise, and why?
Well, everybody who invests always has an investment objective. And so long-term, in that book, the analysis was that if you are going to go long-term and you have what it takes, go straight to the long-term market. And the long-term market can be maybe some bonds or long-dated bonds, or you go straight to the stock market. And when you go straight to the stock market and you buy your stocks, then you are entitled to your dividends, your capital gains, and of course, your capital losses as well. And in their opinion, they think that that direct exchange for the long-term objective pays more than to join a pool that will share. So I think it's their investment objective orientation that is informing that. But for somebody who is also very risk averse, the moment he sees the market fall, he's scared. He doesn't have much to lose. He doesn't have much to spare. Such a person, it's too much risky to just go straight to the market in the name of the recommendations cited in the book. You cushion yourself a bit by the pooling of all contributors and the sharing of risk and returns through the mutual funds. So it depends actually on the investment objective and orientation.
Okay. So Mr. Machine Man, Fidelis is asking again, is there any advantage associated with transferring funds from your bank into a pool of physically depositing fiat money?
I don't get that question.
Okay, me neither. Fidelis, please, can you come back again? Okay, I think they're into a pool of physically depositing fiat money. If you could clarify that a bit, okay? Bashiru, let's say I have a kid brother I want to do MF mutual fund for and personally plan to buy one. Is it advisable to combine the two or have it separately?
If you have a kid brother and you want to buy a mutual fund for him, because it's a kid brother, the objective for that brother, that small little boy, is different from the objective for you, the adult. Remember that mutual fund types based on asset class, based on structure and things I shared earlier. So your younger brother, the objective may be that when he turns 18, you need some money for him. Yours may be that maybe you need it in the next 1 year. So based on these two different objectives, you can mix the two. So you can open a mutual fund in trust for your younger brother, and you can open another one for yourself.
Okay. So, as Sabigi Abdul Razak is asking, can you help me with some reliable state financial institutions where it's advisable for me to buy a mutual fund from? Please, I really need it because I'm a beginner.
It says, can you do what? Help me with some state institutions.
With some reliable, yes, please. State financial institutions.
So you can pick that easily when we start talking about the 6 tips.
Okay, so as Abigi, sit tight as we move to the 6 tips very soon. Edmond, it's been asserted that some mutual fund companies invest their investors' fund into cryptocurrencies. How true is that?
Well, before you invest, remember all the time that mutual fund has types, and usually when you pick your scheme particular.
Doctor, please, did you hear me?
Yes, I did. Julia, yes, I did.
Okay.
So I'm saying that always check the asset classes from the scheme particular. We call something scheme particulars. When I talked about let me look at what I talked about that and said that. When I talked about offer document, before you buy a mutual fund, point 5, the offer document details out what the fund is investing in. So you have to check. And usually if you find anything that is not regulated in there, then you are in danger of losing your money. For now, I haven't cited any regulatory approval for investing in crypto in Ghana. And so be careful if you are buying a mutual fund that says it's invest in cryptocurrency. I see a question on Facebook that I would love to answer. Somebody is asking on Facebook that can you buy mutual fund for the purpose of marriage? Why not? It's an objective. So you have to know when you want to marry, how much you need to marry. And based on these two things, you can know which investment to buy and for how long, so that you know when to withdraw in order to raise the amount of money you're looking for. So yes, it's an objective you can use. Zador Wooten is also saying this is very insightful. Thank you. And this is from Facebook. Is there any question for me, Julia?
Yes, there are. I was so excited about the marriage one, but I mean, what about if he's using it to buy a car for the wife anyway?
That is objective.
So Edmond, okay, I've done Edmond. Okay, so Papa C is asking, please, how do we get access to this presentation? Some of us joined the meeting quite late. Oh, due to time difference.
Okay. I'm sure some joined from South Africa, some joined from Cameroon, some joined from Zambia. It's understandable. If you go to the FLF Africa page on Facebook, this will be there. We would also be editing the final video and put it on our YouTube page. So go to YouTube, type Richmond Kwame from Point, the page will pop up, subscribe, and you have this there.
Can I ask a question?
Go ahead, please.
Yes, my question is, you talk about panic withdrawal. Panic withdrawal, I mean, yes, and I'm assuming I buy a mutual fund for 5 years. Then for consistently 3 years, the price of the shares that they invested my money in keep going down. If I withdraw within these 3 years, number one, is it panic withdrawal? The second one is that I invested in a mutual fund. Then the fund manager realized that there are credibility issues to his name. But initially, I did not know, and that he's indebted to his eyeballs, and people are chasing him here and there. And I withdraw from the mutual fund.
Explain your last example again, please.
I invested in a company. I bought my mutual funds, and I mean, recently I just realized that the fund manager has credibility issues. Probably he has been indebted to his eyeballs, or people are chasing him for money for one or two things he got into. Then because of those things, even though it's not affecting my fund, I decided to withdraw. Is it panic withdrawal?
So this person you are talking about has license with the fund he's managing, right?
Yes.
But his only problem is what? Credibility issues with the regulator.
Yes. Yes.
Okay. Now, always know that mutual funds are companies on their own. They are limited companies on their own. And they are different from the fund house. The fund house is the asset management company. Mutual funds also are companies on their own with their own board. So you notice that recently in Ghana, when the Securities and Exchange Commission reviewed the licenses of some fund houses, their mutual funds were still active and regular. And so they did not withdraw the licenses of the funds, because the fund house and the fund manager, they are two different groups of people. So you notice that those who lost their licenses as maybe asset management companies, their mutual funds were given to other fund managers who were still in business to manage. So in this instance, if the fund house had lost their credibility, they had licensing issues, as long as the fundamentals and the regulations for the mutual fund was still intact and it was doing well, then you needed not to panic to withdraw. Why? Because another manager had been appointed to handle same.
Okay, what about the one in which every year the price of shares keep going down?
So again, if remember we talked about recommended holding period, which we call the lock-in period on point 3. And so if, for example, the fund's maturity supposedly a minimum period is maybe 5 years, and in 3 consecutive years it is falling, and you withdraw on the 3rd year, you are still shooting yourself in the foot. Why? Because the minimum recommended holding period duration is not due. And usually when you do that, in addition to losing out on the falling price, you also get some charges as exit loads. So you lose twice. So you should always be careful when you are withdrawing if it's going to affect you, particularly if the duration is not due. Now, for some, the duration may be due and even pass, but it's still falling. You can equally cut your losses if you still feel uncomfortable and you think the fundamentals are still not right, and just exit and move on. Thank you. All right, I think our time.
Hello, Richmond.
Yes.
Can I continue picking? There are some 3 more questions here.
Let's pick a few and we can end. Our time is up.
Okay, so Lavina, investing in mutual funds and premium for insurance, which is more beneficial?
There are 2 different categories of financial instruments. A premium for insurance is the price you are paying to safeguard a potential risk in the future. It is not necessarily an investment you can go and pick later. If the event of the bad incident you are preventing with that premium doesn't kick in, you don't exercise the right to have it. An investment doesn't recognize any event. You put the money in, duration is this, in a mutual fund. You go back, you have access to your money and or returns. So there are 2 different instances. An insurance is a safeguard against a potential risk. An investment is money you put down so you can make some returns and you can take it anytime.
Okay, then lastly these 2 people have already asked questions. So okay, so Richmond is asking, which is better, float load charge or exit load charge?
Well, it depends on when you need your money and your investment objective. Actually it is front load. So if it is front load, it means the moment you put your money in, the charges are active. If it's exit load, it means you have to wait till the last time. If the maturity is not due, then they will activate the exit load. So it depends on your objective. If you need the money now in a short term, then you don't have an option to go into a front load. If it is a long term beyond a certain minimum duration, then you probably work with the exit. But of course, there are some that doesn't have any. So in your checking, you can check for those that probably have none. And even sometimes you can check the one that has the cheapest or the lowest, either front or exit. It still works. Because of time, Julia, if there's no question, I can conclude.
I have a question.
Somebody says he has a question. Go ahead, sir.
Please, if in case I have invested.
We can't hear you, please.
Please, is it okay? Can you hear me now?
Your voice is far.
Okay. No.
Yes, better.
Yeah, please, if you can hear me.
We can hear you. Go ahead, please.
Okay. If I have invested 100 cedis for 7 years as of now, and
your voice is back again.
Is it okay, please?
Not too good.
Oh, sorry. Okay, is now okay?
Go ahead.
Okay, I said if I have invested 100 cedis for 7 years now and I have not had any information from my fund manager, does it mean that my account is being dormant, or because I didn't invest much, that is why I doesn't have the information?
Not at all. Even if you invested a CD and they gave you an account, they must update you. And actually, they are supposed to do by law almost every year. You're a shareholder, and they do annual general meetings every year. They are supposed to send you annual reports. So if you have not heard from them 7 years now, it doesn't matter how much. Try and visit them, place a call to them, and let them send you some statement. By now, they should even have access to online balance checking and things like that. It's a dangerous clue that after 7 years, your fund manager has not had any feedback to give you.
Thank you very much. And one last question. Do you have to study the financial markets well before you can invest in fund management?
Before you can invest in
mutual fund?
Oh, you just need to understand the basic things like we have shared. If you really understood what we shared in this basic session, it's enough to help you take any mutual fund investment decision. If you want to advance it, you can take a course at the Ghana Stock Exchange. All right. So.
Okay, Richmond.
Yes.
Richmond, please, there's a question from Facebook, a follow-up on our marriage question. And it's saying the target for the marriage is probably 100,000 Ghana cedis. And he plans to meet it in 2 years' time. How much should he start to be able to hit his targets?
Okay, so basically 100,000, and how much does he have now to start? That is important to know. Based on the amount you have, we can take it out of the 100,000, and whatever is left, we'll divide it by 48 months, and then we will ask you which amount out of that figure you'll be able to put down. Then whatever is outstanding, we'll check which mutual fund that have the history of being able to deliver same or near or close in 2 years. Then if it is possible, you can know by looking at that. If it's not possible, you can equally know, and your fund manager can tell you whether it's possible or not.
I have a question.
Go ahead, sir.
Yes, I would like to know who, we all know we have the policeman that checks us. So in this case, who checks the policeman? That is, how would you know what your fund manager is doing with your money is in the right order? Or if he's doing something bad, how would you know? Thank you.
It's very simple. If you want to tell if your fund manager is doing something that is not right, you call on the Ghana Stock, the Securities and Exchange Commission, and you put the fund manager name to them and ask them if the fund manager is in their right books, and they'll be able to tell you, because they audit them, they check on them, they'll be able to tell you if they are in the right standing. So anytime at all, you can always call the Securities and Exchange Commission and give the name of the fund manager.
Sorry, what I mean is actually some of us are not very financially inclined, like, you bigger folks, but how would you even know? Some of us might just buy the funds and then be doing something else, expecting a monthly flow and all that. You might not even know what they are doing with your funds and all that. Does it mean there will be? Yeah, thank you.
So for you that have already bought without any of these basic understanding, it's a fact already, you've bought already. Now with this little learnings we are doing, you should be able to go back and be interested in how your fund is doing. Ask for statements. Check what you put in, look at the duration, how much it is returning. If the duration you put it there is past, deliberately withdraw and see if they will be able to pay you within time. If they pay you, then it gives you an idea. Occasionally, we can even give you some numbers you can call, just as a mystery shopper, to call and check. Stock Exchange, Securities Exchange Commission, this company, what do you think about them? They give you some feedback. So first and foremost, practice what we have shared. Number two, go and check your balances. Number three, test the system. Test it and see. If you want to withdraw, how is it? Are you able to get it? Is it easy to get it? And things like that.
Okay, thank you.
All right.
Hello, Doc.
Yes, sir. Yes, sir.
Good evening, sir.
Good evening.
This is Maxwell from Saturday.
Right, Max, let's hear you.
Okay. Doc, please, I would like to know what are some of the key factors that one has to take a critical look at when he or she wants to invest with an asset management firm.
Okay, so that takes me quickly into, so first and foremost, remember this slide. Before you buy a mutual fund, check the fund units, check the NAV, check the lock-in period, check the load charges, check the offer document. We've already talked about this. Then number 6, check the assets under management, check the expense ratio, check if there's a new fund offer, check the redemption. When we talk about 5 mistakes you should avoid, now we are talking about 6 things you have to check before you even take a decision. Number 1, make sure the person you are buying the mutual fund from or the fund house has a license first and foremost as a fund house, so as an asset management company. Number 2, check if they have the mutual fund itself is registered and also licensed by the Securities and Exchange Commission. So the fund house itself or the investment company, and then the mutual fund itself must be a company that is also licensed. Number 3, check the people behind the mutual fund and behind the fund house. So the mutual fund must have a board, and usually that is a different board from the board of the asset management. So check the people behind the mutual fund and check the people behind the fund house so that you can tell who is behind it, their background, their experiences, and things like that. Number 4, look at the return history. In mutual funds, past returns does not guarantee future returns, but still take a look at what they have done over the period. So if they have been around for 5 years, in the 5 years, what is their return history? If for the 5 years they have been returning 0 and negative, it should tell you. If for the 5 years they have been returning great, it should tell you. So it gives you an idea as to the kind of people you are handing your funds to manage. Number 5, what have they been cited for negatively by the regulator? So check, have they been cited for anything by the regulator? And then number 6, how long have this whole mutual fund been around for? And what is the total size of assets that this mutual fund is holding? And how many people are even invested in this? You can get all these answered when you visit them and you ask them, and they should be able to speak to that for you.
Okay, thank you very much. Please, another follow-up question.
Right.
I would like to know, these asset management firms, they have sales reps who help them one way or the other in marketing these mutual funds. And most of the times, because these sales reps have targets to meet, they tend to make their presentations look very juicy. I mean, promising lots of returns and the likes of the rest, but you plug yourself in, and at the end of the maturity, you get to see it is something different, or along the line, you realize what the sales rep told you is quite different from what is really happening. In this case, me as an investor or as a customer, what can I do?
Very simple. Remember, we talked about checking the offer document. Check the offer document. Don't just buy a fund based on what the salesperson or the relationship manager is telling you. Before you buy, ask for the scheme particulars. It's the same as the offer document on point 5. In there, it will give you everything you need to know: the asset classes, the objectives, what the fund is able to do, what it's not able to do. And even before you sign your form, read the conditions that are accompanying it. It will expose the fund history. Sometimes even the scheme particular will give you the fund history, the performance, the risk, and everything. And before you sign the final form, the terms and conditions form, that is very small, tiny thing that you sign. It will be able to expose anything that your sales rep is saying that is not right. So don't be in a hurry to buy just because the sales rep says. Use what we have learned practically. We have said that a lot of people are putting into a fund and it's being managed by a fund manager. It goes through this cycle. We have said that the fund is based on some assets. So if a salesperson is saying, oh, you can withdraw in 3 months, but you notice that the asset class is an equity asset class, you should know he's telling you lies, because 3 months can be an equity fund. We've talked to you about the structure, open-ended or closed-ended. He says, oh, you can top up at any time, but it's closed-ended. You pick it from the scheme particulars, you know he's lying. He says that, oh, this one, it can pay you some regular returns every 3 months, but the thing says it's a growth fund and it is equity. He should tell you that he's lying. He says, oh, there's no risk at all associated with it. You don't lose anything. Meanwhile, it's investing in equities and it is also a growth fund. He should tell you it is high risk, so you can fall. So this understanding, if you put it into practice, you would be able to know whether they are telling the truth or not. You ask him, is it a load fund or a no load fund? He says it's a load fund. But he comes back to tell there's no charge. It cannot be a load fund and has no charge. There's a management fee, there's a front end load or an exit load. So that guides you to know whoever is telling you what is saying right or wrong. So use these things we are teaching you to equip your own self, so that you don't just take what a service provider is saying, and you can ask the right questions, and you can even double check with the regulator for yourself. Thank you. Now,
thank you very much, Doc.
I think we should end on this note. And we have an app we are going to be launching sometime globally from almost all the countries you're operating from. And it is called the Penny app. It is called the Penny app. Basically, it is just going to be a monitoring app that will guide everybody who wants to build financial immunity, so that it monitors your decision to do whatever you want to do, but you have to sign up for it. So make sure that you subscribe to all our platforms, and we will let it available. We will make it available to you when it's ready, so you can take advantage of it and be guided. You can also, if you're on any of the platforms, particularly the WhatsApp platform, you can register for the challenge. We call it the Count Your Pennies Challenge. That is what the app is going to do. And if you register for the challenge, we can help you out on how you can be supervised in terms of your own decision to put money in your account, or your own decision to put money in your mutual fund, or whatever you want to do. There will be somebody who will be hitting your back every now and then to make sure you are disciplined, you are putting your money at the right place you want to put it, you are not spending your money unnecessarily, and you are following your goals and making sure that you are taking the right decision, so that at least anytime you lose your job, you can build immunity for 6 months with 6 months average income. And if you're on a platform, you can ask for a certificate if you want to, and they can help you out. Go to YouTube, look for Richmond Kwame Frimpong, and you can equally be guided. Thank you very much, and God bless you. Julia, that brings us to the end of this session. Take over and kindly do our last announcements.
Okay, so thank you very much, Richmond, for